Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking moving abroad from the UK, tax and residency traps to avoid in 2025-26 today, and tying it back to the wider cost saver ecosystem, including tools like Moving Abroad UK Tax and Residency Engine, SRT 2526, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Welcome back, everyone. So, today we are getting into something that, honestly, I think half the people I know have fantasized about at some point: moving abroad from the UK. Assad, you must get asked about this constantly.
Oh, all the time, all the time. And look, it's exciting, right? New country, new chapter, all of that. But the thing that catches people off guard is that immigrating isn't just this big life milestone. It's actually, and I know this sounds boring, it's a major tax event.
A tax event? Way to kill the dream, Assad.
I know. But honestly, this is the bit that trips people up. They book the flights, they forward the post, they're mentally already on a beach somewhere, and meanwhile, HMRC is sitting there with a very specific set of rules about whether you've actually left or not.
Wait, what do you mean whether you've actually left? Like, if I move to Spain, I've moved to Spain. Surely that's just a fact?
You think so, right? But residency isn't something you choose. HMRC decides. They use this thing called the Statutory Residency Test, the SRT. And if you get it wrong, you can end up paying tax in two countries, facing penalties of £100 or more per late filing, plus interest that just quietly compounds month after month.
Oh, that's not great.
No. And for someone with even like a modest investment portfolio, a mistimed sale, selling something a week too early or whatever, can trigger a five-figure capital gains tax bill that could have been completely avoided. So the stakes are real.
5 figures, okay. And you mentioned something before we started recording about 2025-26 being a particularly important year for this?
Yeah, so this is the big one. The old non-dom remittance basis, which has been around forever basically, that's been abolished. From the 6th of April 2025, it's replaced with a residence-based regime. And this isn't just for, billionaires with offshore trusts. This affects arrivers, leavers, people coming back. Anyone planning a move in this window needs to understand the new landscape before they pack a single box.
Before they pack a box. Wow. Okay, so let's get into the SRT then. Because I'll be honest, I always thought it was basically just about the 183-day rule. Like, spend fewer than 183 days in the UK and you're non-resident? Is that not right?
So that is, and I say this with love, one of the most expensive mistakes immigrants make.
Oh no.
The 18-3-day thing is one part of it, yes, but the SRT has multiple tests, and a single tie to the UK can pull you back into residency even if you're well under 183 days. The whole thing is more layered than people expect.
Okay, so walk me through it. What are these tests?
Right, so there are three parts, and you work through them in order. First, the automatic overseas tests. These can conclusively make you non-resident. Like if you were UK resident in any of the previous 3 tax years and you spend fewer than 16 days here, 16, you're automatically non-resident.
16 days? That's nothing.
Exactly. Or if you are non-resident in all of the previous 3 years, the threshold is 46 days. And then there's the full-time work overseas test, broadly averaging 35 hours a week overseas, fewer than 91 days in the UK, no more than 30 of those being work days. That's the one most immigrants actually rely on.
Okay, and sorry, what was the second part?
The automatic UK tests. These make you definitely resident. So 183 days or more in the UK, that's your classic one. or if your only home is in the UK for at least 91 consecutive days, or full-time UK work spanning 365 days or more.
Right.
And then, if neither of those automatic tests gives a clear answer, you hit the sufficient ties test. And this is where it gets, well, this is where it gets interesting, or painful, depending on your perspective.
Go on.
So HMRC counts your ties to the UK, things like a UK resident spouse or civil partner or minor child, accommodation that's available to you and you've used even one night, substantive UK work, that's 40 or more workdays, having spent more than 90 days in the UK in either of the previous 2 tax years, and then for leavers specifically, there's a country tie if you spend more time in the UK than in any other single country.
So the more ties you have, the fewer days you can actually spend here?
Exactly. And this is the bit that shocks people. A leaver with 4 ties becomes resident after just 45 days. Not 183, 45.
Wait, really? That's wild. So someone could be living abroad, come back for a few visits, and suddenly they're...
Resident again, yeah. Which is why I bang on about keeping a detailed day count log. Boarding passes, hotel bookings, GP visits. I've even seen Uber receipts used as evidence in HMRC disputes. A calendar-only record is rarely enough.
That sounds exhausting, honestly. Okay, what about split year treatment? Because I know some people leave partway through a tax year, and presumably you don't want the whole year to count as resident.
Right, so ordinarily, you're either resident for the whole tax year or you're not. Split year treatment can carve it into 2 parts, a resident bit and a non-resident bit. But it's not automatic. There are 8 specific cases you have to fit into, and each one has strict conditions.
8 cases? That's a lot.
It is. The most common ones for leavers are Case 1, starting full-time work overseas, Case 2, accompanying a partner who's starting full-time work overseas, and Case 3, ceasing to have a home in the UK. And Case 3 is a good example of how strict these are. You need no UK home for the rest of the tax year, fewer than 16 days in the UK, and you have to become tax resident in another country within 6 months.
And if you miss just one of those conditions?
The whole tax year stays taxable in the UK. I always think of this example. Sarah from Bristol. She sold her flat in October 2025, moved to Dubai, great tech job. But she flew back for 3 weeks over Christmas to help her parents move house. Those extra days pushed her over the 16-day limit for Case 3.
Oh, no.
Her Dubai salary, about £95,000 for the remainder of the tax year, became fully taxable in the UK. Cost her roughly $28,000 in additional tax. A 2-week Christmas visit would have been fine. 3 weeks broke it.
£28,000 for 1 extra week at Christmas? That's heartbreaking, honestly.
It really is. And that's why this stuff matters so much. Does that make sense, the split year thing?
Yeah, no, it does. It's terrifying, but it makes sense. Okay, let's talk about selling assets, because I imagine a lot of people think, great, I'll become non-resident and then sell my investments tax-free. Is that another myth?
Sort of. Yes and no. There are these temporary non-residence rules. So if you leave, become non-resident, sell assets you own before leaving, and then come back within 5 full tax years, those gains get pulled back into UK tax when you return.
5 full tax years.
5 full tax years. The clock is strict. Coming back even a few weeks too early can trigger a full retrospective assessment, so you really need to be planning to stay away from more than 5 years to fully escape it.
And what about UK property specifically? Because a lot of people keep a buy-to-let or...
Yeah, UK property is always in the net. Always. Even if you achieve permanent non-residence, gains on UK residential and commercial properties stay within UK CGT. And here's the other thing people miss. You have to file a non-resident CGT return within 60 days of completion. Miss that deadline, automatic penalties, starting at $100, rising quickly, even if no taxes actually due.
Even if you don't owe anything?
Even if you don't owe anything. It's just, yeah, it's one of those things.
Okay, so property is a whole thing. Let's move on to inheritance tax because you mentioned the non-dom changes affect that too?
Yeah, this is massive. So for decades, IHT was based on domicile, which is this common law concept that's really hard to shed. But from 6th April 2025, it's moved to a residence-based system. If you've been UK resident for at least 10 of the last 20 tax years, you become a long-term resident, and your worldwide estate is within UK IHT scope.
Okay.
And here's the kicker. Even after you leave, that status persists for a tail period of between 3 and 10 years, depending on how long you were resident. So someone who lived here for 15 years, immigrates, could still face UK IHT on their global estate for years after leaving.
Oh, I hadn't thought about it like that. So it's not like you move and it just stops.
No, it follows you. And then there's the wills issue. A UK will might not be valid or effective in your new country. Some countries have forced heirship rules that override English-style testamentary freedom. So you often need a fresh will in your new country drafted to work alongside your UK will rather than revoke it.
That's actually quite alarming. Okay, pensions and ISAs. What happens to those?
Right, so pensions, you can still contribute to a UK personal pension after leaving. For up to 5 tax years after departure, you can put in up to £3,600 gross per year and still get basic rate tax relief even with no UK earnings. But drawing pension income as a non-resident depends heavily on the double taxation agreement with your new country. Some treaties give sole taxing rights to your country of residence, others allow both countries to tax it.
And ISAs?
ISAs are simpler in one way. You can't contribute once you're non-resident, with a narrow exception for Crown employees overseas. Your existing ISAs keep their UK tax-free status, but, and this is the bit that catches people, almost no other country recognizes that. Most jurisdictions will just tax the income and gains inside your ISA as if it were an ordinary account.
Oh, I didn't realize that. So your ISA is basically only tax-free in the UK's eyes.
Pretty much, yeah, which is kind of a lot when you think about how much people have saved into them.
Hmm. What about if you keep a rental property and you're getting income from that while abroad?
So there's the non-resident landlord scheme. If you rent out UK property while non-resident, your letting agent or even tenants paying more than $100 a week directly has to withhold basic rate tax from the rent, unless you register with HMRC scheme, which lets you receive the rent gross and settle through self-assessment. It's a form, not a favor. Failing to register doesn't save you tax, it just means your agent withholds and you have to reclaim, tying up cash for months.
Ah, fair enough. And dividends, interest?
Non-residents generally pay no UK tax on UK dividends or bank interest thanks to disregarded income rules. But, and there's always a but, you lose your personal allowance for other UK income. So you actually need to model both scenarios to see what works best. Have I explained that clearly?
Yeah, I think so. It's basically trade-offs everywhere. Okay, so for someone who's sitting here thinking, right, I'm moving in 6 months, what should they actually do, like practically?
Okay, and I'd say most of this can be done in a couple of focused evenings, honestly. First, confirm your expected residency status under the SRT for the year you leave and the year after. Check whether split year treatment applies and which case you're relying on. Model the CGT position on anything you might sell around the move.
Right.
Review pension contributions. Use any unused allowances before you go. Update your will and think about IHT under the new rules. Notify HMRC with a P85 form. Register for the non-resident landlord scheme if you're letting property. Check the double taxation agreement with your destination. Keep meticulous records of travel days and ties.
And the last one?
Get destination country tax advice before you arrive, not after. That's the one people always skip and always regret.
Before you arrive. Noted. What are the mistakes you see over and over, like the ones that make you want to bang your head on the desk?
Oh, where do I start? Selling a UK rental property in the year of departure without checking the CGT position. Assuming a P85 form closes your tax affairs when self-assessment is still required. taking a big pension lump sum in the year you leave and getting taxed on it as if you're still resident.
Ouch.
Coming back for a family emergency and staying too long, breaking the full-time work overseas test. Keeping a UK home just in case without realizing it counts as a residency tie. And the classic, not filing the 60-day non-resident CGT return on a property sale.
And I suppose the question everyone asks is, will HMRC actually check? Because it feels like a lot of detail to police.
Yes, short answer, yes. They get data from foreign tax authorities under the Common Reporting Standard. They get information from letting agents, companies' house, pension providers. Discrepancies are increasingly picked up automatically now. Getting it right first time is it's so much cheaper than defending an inquiry 3 years later.
Yeah, that's actually reassuring in a weird way. Like, at least there's a reason to do it properly.
Exactly. The system rewards the people who plan.
Okay, so to wrap this up, because there's been a lot, if I had to boil it down to like the key takeaways for someone planning to move abroad from the UK this year, what would they be?
I'd say 4 things. 1, residency is not your choice. It's HMRC's. Learn the SRT inside out and count your days religiously. 2, don't sell anything significant around the time of your move without modeling the CGT, especially with the 5-year temporary non-residence rule. 3, the new residence-based IHT regime from April 2025 means your worldwide estate could follow you abroad for years, so get your will and estate planning sorted early. And 4, get professional advice if you have property, pensions, a company, or share options. Fees of $500 to $1,500 for a proper exit review routinely save many times that.
And do the work up front.
Do the work up front. Leave on your terms, not HMRC's.
Brilliant. Assad, thank you. That was honestly really eye-opening. I feel like everyone planning a move needs to hear this before they get carried away with Pinterest boards of Mediterranean kitchens.
The Mediterranean kitchen can wait until the P85 is filed.
Fair enough. Thanks everyone for listening. We'll see you next time. Quick side note, this guide connects with other cost-saver blogs, especially Company Car versus Cash Allowance, Pension Carry Forward, and Pension Carry Forward Guide.
Exactly. And reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Moving Abroad UK Tax and Residency Engine, SRT 2526, right after this episode.
Primary sources used here include HMRC RDR3 and HMRC Tax on Foreign Income and Residency, so you can verify the data yourself and stay evidence-led.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Moving Abroad UK Tax and Residency Engine, SRT 2526, then read Company Car versus Cash Allowance, and use them together to take action today.